Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo nightly video for the first of a new month here in September, still in 2022. Let's get the big picture in mind, because tomorrow the big news is going to be the unemployment situation, and that's just the monthly non-farm payrolls, or we like to call it the monthly jobs report. That'll take place right before the market opens tomorrow, September 2nd. So let's get started there. We'll take a quick look at the dollar, the yields, the bonds, crude, and equities, and then finish up by talking about which stocks, one in particular, Nvidia, just made new fresh 52-week lows in ongoing downtrends. Let's start right here with the employment situation. We hinted on this on Tuesday to see the expectations. Now, last month, the expectations were for, I think it was about 250 or so, and the outcome was double that. And double was about 528,000 new jobs, new payrolls added to the employment rate. And the unemployment rate stayed the same. So will that be the same? The expectation is for about 300,000 jobs to be created. And we never know what's going to happen, but we know what the market and how the market moves. It can be volatile if there is a surprise. So if there is more than expected, or fewer than expected, that will be something that could move markets and could jolt the markets across the board into additional trends. Stocks that will be lower, bonds and crude, that will be lower, and that will come to that just in a little bit later. But the jobs report, the non-farm payrolls, our Friday jobs report, will give us more information about the state of the economy. And of course, the big debate, recession, no recession, GDP growth, but also strong jobs. We'll have more information on that. And of course, what the Fed is looking to do if there is any surprise in the jobs report. That'll come out pre-market tomorrow. Outside of that, we have a continuation of the downtrend in motion. So in prior videos, just giving updates as we continue to trade lower, that the reward pathway is and remains to the downside, and the risk pathway is over. The risk was for continued upside break, just like it was at the end of March into April, and that did not play. The risk was there, the positions were protected, but the market did ultimately turn, and in the event of April and then into June, the market went on to make new equity lows. Will it happen again? That is the reward pathway. Now, that being said, let's see what other movements in currencies or in bonds and commodities are afoot. No particular order. As the equity market trades lower and takes a tumble down from 4300 in the S&P, the dollar index at the same time takes a surge. And that was the play a few weeks ago, almost a month ago. The play was a potential bounce and continuation of the uptrend in the dollar. And that looked like this in real time, back in the time. We have achieved that and exceeded it. So the dollar, the U.S. currency, the defensive hedge, the protection currency, that has made a new 2020 high, similar to the prior moments or the prior pullbacks, which led to the current swing, again taking the dollar up to a new high, flipping back to the other side of the equity market, which has been for the most part in a downtrend. That same strength in the dollar, or bull flag, or retracement up, has resulted in a stellar sell-off of about 10% in the equity market. The Nasdaq has taken a big hit, or the brunt of that selling, being in a technology sector, and technology stocks for the most part tend to be sensitive to higher interest rates. That's the other side of the coin, that as the bond market trades lower, as the dollar trades higher, as stocks trade lower, the yield on that 10-year and others, and the other yields, the Fed does not control the 10-year, but that's an economic or a market-driven index, that continued to trade to new highs. And that is the play, that was the expectation in the event that we see what we are seeing, which is the dollar strengthens. We're going to see strength or a rally in the yield market. Again, this is yield. And what that refers to when it looks at 3%, that's when we mark the 30 level. 30 is not 30%. It is 3%. 20 is not 20%. It is 2%. That's just the way the TNX is calculated. you can take a look at other yield charts on the 2-year or even the 30-year. Now that translates the other way to the bond market. And we'll look at the TLT, because that same logic is playing out to the downside with a bear or a pro trend. Pro trend in this case is down continuity. And that does target the prior low. That's about 108 per share. And that is down from 120 on the ETF. On ZN, that is your actual tradable futures contract. And ZB, that is your 30-year treasury note or treasury bond. That also goes to the 2-year and etc. You can take a look at those or have positions if you wish in those. Another one might be the IEF. Not something I talk about or trade that often. I will trade TLT, but the IEF is a little shorter dated duration. On the other hand, we're looking at crude, which is now piercing lows. And that has had a strong 2020 or 2022. We're now seeing the weakness in the energy sector and in crude. So those are things to keep a watch on as well. But to me, it's this combination, if I could sort of show it this way. Looking at our overnight futures, in fact, let's go up to the daily chart. Let's go up all these, and you can always compare on a quad grid or whatever time frame you'd like to assess. Let's put the S&P right here. Let's put the TLT beneath it. Let's put the dollar up at the top, DXY, and on the bottom, let's put the treasury yield, TNX. All these markets are different, except for these. The bond market, TLT, is going to be trading lower with stocks. So again, this most recent sell swing taking it down to lows, and the most recent upswing in the dollar, upswing in the yield market, has resulted in weakness for equity futures and equity products. And of course, individual sectors have been in that mix as well. Will the jobs report be something that turns these trends and therefore rejects the dollar down, rejects the yields down, turns the bond market up, turns the stock market back up? Or will it be one more piece of evidence that continues these current trends? And if so, an end result for a plan might be equities making new lows, bonds also making new lows. The dollar has already made a new high. Maybe the yield will similarly make new highs. We can call this intermarket or cross-market structure. If you're trading just the equity market, these are just side markets to take a look at and study, and that's how it plays into your market, the equity futures. Of course, any individual sector will actually push this to the red. Individual sectors, be it financials, be it technology, discretionary, etc., as they continue their downtrends in the broader market. Same is true, of course, for the Russell and the Dow mini futures. Speaking of those, which stocks in the S&P, if I will visualize this quickly, what was the market participation today? Today it was not necessarily all down. It was down in the morning session, but the mid-session did reverse. So we are seeing a mixed bag of weakness in the technology sector, that is XLK, and energy, that's XLE. But we are seeing some strength across the board, at least into the close of the market, and that'll take place in some of the defensive names, including healthcare, staples, and utilities. But they don't make up as much of a market cap or market influence as technology and some of the other sectors. Speaking of that, we'll take a look at which stocks in the S&P 500 made new yearly highs. Just for interest, only one of them was Cardinal Health, but there were many, many more stocks in today's session. And we scan, and I often show these in the videos, these are stocks making new 52-week lows in the S&P 500. And I sort these by market cap. The logic is if a stock is making new lows, it has a better shot to continue making new lows. And we can put these on a list of bear or weak or relative weakness candidates in the market. If the market trades lower, continues lower, these stocks are already at lows and probably will continue making fresh new lows. And that gives profits to the put or the bear side of these stocks or the market in general. Just to look at some of them on the bigger perspective here. The first stock we'll look at is Nvidia, which continues its daily chart downtrend to new 52-week lows. Beneath that, in market cap terms, is Verizon. Again, remember the S&P is not quite making those lows. Neither are the Nasdaq, the Dow, or the Russell, but these stocks are. Therefore, they're leading the market to the downside. CRM, Salesforce.com, is a weak stock getting weaker. Intel is another weak stock getting weaker. And we have Medtronics, MDT. We'll take a look at some of the others. I'll put them up. We won't scan all of them, but these are some of the stocks that continue to make new lows. You can sort this through your load the scan query, public new yearly lows, and you can sort and filter and scan weeklies or optionable or other indexes or even custom indexes you might want to scan. But these are the stocks at the moment that are making new lows sorted by market cap. Currently there are 37 and they are underperforming the market, meaning they're going down more, but that market itself is trading to the downside. Jobs report tomorrow could be a market mover, could be a fizzle. We'll take a quick look at our expected move logic. What does the market say about that expected move? Roughly speaking, the implied volatility for tomorrow's session, it's about 30%. That translates into an expected move of about 49 points, let's say 50 points up or down in the S&P. If you have an individual stock or individual equity or futures product or ETF, you might want to look at that to see what the market is pricing in for the jobs report and whether we go beyond that boundary or we stay within it. And that will dictate some of the trades for Friday and beyond. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for September the 1st, 2022.